Hey guys, welcome back to another entry for the Phoenician League Notes from the Frontier. I'm Joe Withrow, broadcasting from my solar shed way up in the mountains of Virginia here, completely off the grid in the office. And in our last video, we talked in detail about reserve assets as part of building a bulletproof asset portfolio. For today's topic, we're going to talk about how to strategically warehouse cash. And we're going to start with this. When we talk about cash, we're talking about fiat currency like US dollars, euro, yen, and the others. Obviously, it's a good idea to keep a little bit of cash in the bank at all times. Here in the US, I think it's wise to have some physical cash on hand as well, just in case we were to need it in a pinch. But here's an important nuance that mainstream finance doesn't understand. Holding cash is about pure liquidity, not about stockpiling money. We don't want to hold the bulk of our money in cash. That's why reserve assets are so important. We allocate to gold and Bitcoin specifically to save money. As I mentioned in the previous video, I don't think we should view gold and Bitcoin as investments that we buy, hoping to sell them later. Instead, they should be the cornerstone of our asset portfolio. And that's because gold and Bitcoin, they are our reserves. We buy them specifically to move out of fiat money and into higher quality assets. But the problem with cash, the problem with cash, I should say, is that it loses purchasing power over time. This is why it's important to strategically warehouse it. Sometimes cash loses purchasing power exceptionally fast due to high inflation, and I should say in quotes high inflation, right? But it's still losing value during normal times as well, and that's because inflation is a function of policy. In the U.S., the Federal Reserve, the Fed, has a stated policy goal of 2% inflation annually. That means it deliberately wants to cause the U.S. dollar to lose 2% of its purchasing power every year. Now, of course, they don't say it that way. They pretend that inflation is about rising prices and asset values. But rising prices is just the result of inflation. Inflation is the act of expanding the money supply. That's what it is. And this can be done simply by printing money at the central bank. But the current system has a myriad of other more nuanced ways to expand the money supply as well. And these things get pretty complicated. We're talking about the Fed's open market operations, its reverse repo facility, standing repo facility, the lending that takes place through the Fed's discount window, and its foreign exchange swaps. Those can all be used to inject dollars into the financial system to increase liquidity. And then, of course, we've got a fractional reserve banking system in which the banks can lend a fraction of their reserves to inject liquidity into the system. Then there's all kinds of securitization and off balance sheet vehicles that the commercial banks use to increase liquidity as well. And so each of those expand the money supply. All right. So we should note that all these activities tend to create boom bust cycles. But that's a topic for another day. The key here is that cash will constantly lose purchasing power over time for as long as the current monetary system remains in place. Okay? And that's why we don't stockpile money in cash. It would be like storing water in a bucket riddled with holes. Our purchasing power would just gradually leak out on us. Still, it is a good idea to keep some cash so that we have liquidity. Okay, here's what I mean. If we have an unexpected expense pop up, it's ideal to have the ability to take care of it without needing to sell or borrow against any of our other assets. In just the same way, it's good to gradually build up the cash balance we need to make larger investments over time as well. So here I'm thinking about our cash flow investments. We'll talk more about those in a later entry. All right. But that's why we still want to hold some cash, but we should be strategic about how we warehouse it so that we can fix the leaks in our bucket, and keep up with inflation. Now, it was much harder to strategically warehouse cash during the ZIRP era. It's the era of zero interest rate policy. And that was when the central banks collaborated to keep interest rates at zero. However, we have some options now that rates have normalized. They are money market accounts, short term US Treasury bills, and max funded life insurance policies. All right. Money market accounts are the most simple and straightforward. These are a type of savings account at the bank that pays interest on deposits while still allowing a limited number of transactions or withdrawals each month. And so this option provides the best liquidity because we can instantly access the cash in our money market accounts if we need to. The trade off is that these accounts will typically generate the lowest return on our money compared to the other two. U.S. Treasuries and max funded life insurance. So personally, I like to keep the cash reserves I hold for my rental properties in money market accounts. And right now, those accounts are paying me between 4 and 4.5% as I produce this. And that's annually, 4.5% annually in interest. Yet they provide me with instant liquidity. Should something come up with one of my properties, I can instantly move money out of the money market account and use it to cover any expenses as needed. All right, so that's what I mean by having pure liquidity. Now, short term US Treasury bills are also simple and straightforward after you've learned the ropes. And these are US government debt securities that mature in 1 year or less. Okay, so buying a Treasury bill is effectively lending money to the US government for the designated period of time. And I would not do long term bonds here. But when we're talking about bills, Treasury bills maturing in 1 month, 2 months, 3 months, 4 months, 6 months, and even 12 months, I'm comfortable with. And Treasury bills usually pay a higher interest rate as compared to money market accounts. And in fact, money market accounts probably derive their return by investing in treasuries themselves. Okay, but the thing is, Treasury bills do not provide instant liquidity. We can't just access our money until the debt instrument matures. We could potentially sell it, but we don't want to get into that. That there's short-term price fluctuations that could be impactful if we're not holding to maturity. Okay, so a little bit higher return, but not as much liquidity with U.S. Treasuries. Now, let's talk about max funded life insurance policies. Okay, these are more nuanced and less utilized today. They're by far, in my opinion, the best option for people with a longer term time horizon. But most people don't understand these things. They don't understand how they work because there's not a structured product. Everything has to be customized. Okay, so when we talk about max funded life insurance, these are life insurance contracts designed to create outsized cash value within the policy itself over time. And now make no mistake about it, these policies are dramatically superior to standard life insurance. Okay. We're not talking about standard life insurance. And I know there's sometimes a stigma attached to life insurance, and I realize that it might not be suitable in some cases. Everybody's situation is different. But life insurance is a tax efficient vehicle that will provide us with uninterrupted compounding and complete liquidity at the same time. It's unique in that, to my knowledge, it's the only vehicle that provides both compounding and complete liquidity. Okay, and that means we can use our life insurance cash value for other investments or expenses if we needed to. We can access our cash value at any time, yet we'll still generate a return on it inside the policy. Okay, so in a sense, we can leverage the same dollars twice. They generate a compounding return inside the max funded life insurance policy, and we can still use the cash value to also make other investments or pay expenses outside the policy. All right. This is why the banks and the insurance companies, they love max funded life insurance. They use this strategy themselves, so they don't advertise it. The key here is that we need to structure these policies according to the infinite banking concept, which is IBC. Okay. And that typically requires that we work with a specialist who understands the nuances of this strategy. So, putting it simply, infinite banking policies are not traditional life insurance policies. Okay. Our goal with them isn't to buy life insurance. Instead, our goal is to strategically warehouse cash in such a way that it will generate a compounding return each year, yet still provide us with complete liquidity. All right. So typical IBC policies are structured such that only a small percentage of the premium paid actually supports the base life insurance policy, which is the death benefit that the beneficiary receives when the insured person passes away. Okay. Only a small percentage of the premium goes to that with IBC policies. The remaining bulk of the premium goes to accelerate the growth of cash value inside the policy. Okay, and that's why I refer to these as max funded policies. All right. And the result here is that we can build cash value very quickly. Then we can access that cash value at any time for any reason without having to sell anything or create a taxable event. Okay, that's important. We always want to be tax efficient. Okay, so I'm going to show you an example here to demonstrate how this works. All right. So this is a max funded policy performance illustration that I pulled from one of my policies. Okay. So this is a real world example. There's no hypotheticals with this. Now, I know there appears to be a lot going on in this graphic, but it's really quite simple. At the top of the chart, we can see three distinct categories. The first is premium breakdown, shaded in gray. It shows us the total premium we'll have to pay each year to keep this contract in force. All right. The second column is labeled guaranteed. This refers to the policy's cash value and death benefit. All right. Even if the life insurance company never pays us a dividend, we are contractually guaranteed to have the total cash value and death benefit listed in this column by year, as long as we pay the annual policy premium. All right. So it's a guaranteed return. The third column we see here is labeled non guaranteed, and it's shaded in gray as well. This column lists the dividends we'll receive each year if the life insurance company continues to pay dividends at its current schedule. Okay, so the dividends accelerate the growth of both our cash value and our death benefit, as we can see in this example. All right, so let's walk through this here. We can see that the premium for this policy is $4,000 a year for the next 15 years. All right, and that's a total outlay of $60,000 over those 15 years. As long as I pay this premium each year, I'm guaranteed to have $69,312 in cash value after those 15 years. Okay. So that's a conservative return of 15.5% on my money, right? Because I'm going to put in $60,000. That's what I'm paying in premium. And I'm going to have 69,312 guaranteed. However, if the life insurance company continues to pay dividends at the current schedule, check this out. I will have $81,559 in cash value after those 15 years. Okay. That's a return of 35.9% on my money. And that's with no market risk, meaning my cash value can't go down. Once I have it, it's there. It's not tied to the markets or anything else. Okay. So when I make my $4,000 premium payment each year, I don't see that as an expense. To me, it's savings because my money's going to grow. It's like depositing the money into a bank account, except much more strategic. And don't get me wrong, I don't have to wait 15 years to access my money. As we can see in this illustration, my cash value grows every single year. I can use that money for anything I want to at any time. There are no restrictions. Now, look at what happens starting in year 16. The policy premium for this particular contract drops from $4,000 to $608 a year. Right? So I had to pay $4,000 a year for 15 years. Starting in year 16, I only have to pay $608 a year to keep the contract in force. Okay. That's because I was paying $3,392 a year for accelerated cash value growth. But I don't have to do that after 15 years. I can pay the base $608 and my cash value will still grow year after year. So if I were to fund this contract for another 15 years, right? So 30 years in total. The first 15 years cost me $60,000 in cash outlay in premium, right? It would cost me only $9,120 more to fund this policy for the next 15 years, right? That's a total outlay of $69,120 over 30 years. Okay? Yeah, look at the guaranteed column. I'm guaranteed to have a cash value of $114,222 after 30 years. And if the company continues paying dividends on schedule, my cash value would be $183,108. That means I will have grown my money by at least 65% in the guaranteed column and perhaps by as much as 164%. And again, this is without sacrificing any liquidity. I can access my cash value at any point along the way for any reason. Now, one nuance here to bring up, it does take about a week or so to get the cash. I could request any amount of cash and the insurance company would send it to me, but it is going to take about a week to get it. Okay. That's why money market accounts, when I talk about those, are pure liquidity. You have those funds at any time. There's no delay. But with the max funded life insurance, it does take about a week, but you can get any amount of money up to the maximum cash value that you have. All right. That's the power of max funded life insurance. It's a great vehicle to strategically warehouse cash. And as a bonus, it also provides us with life insurance coverage, right? That's just a bonus, right? That's not the purpose. And as you can see in this example, the death benefit starts at $247,525. Then it grows to $617,310 after the first 15 years. And then after 30 years, that death benefit's $773,272. Okay. That's a nice little chunk of change for the beneficiary to inherit. So I hope you can see why I believe so strongly in max funded life insurance according to IBC principles. These are tax efficient vehicles that enable us to strategically warehouse our cash over time without sacrificing liquidity. And I should add that these policies are completely flexible. I'm demonstrating a policy here that starts with a $4,000 annual premium, but there's nothing magical about that number. You can set up bigger or smaller policies as you see fit. I mean, you can pick a number and say, I can afford X dollars a year. I want to put X dollars a year into this strategy. And you can customize a policy based on that. Okay. You choose your own level of involvement here. Um, and by the way, and this just shows an even $4,000 premium each year. You can also set up policies where you just drop a large chunk of money into them in year one. You pay the most in premium in year one, and then have a smaller annual premium after that. So the strategy is completely customizable. All right. Feel free to reach out to me if you would like more information on how to get started with something like this. And I want to also shout out, you can check out my friends at Remnant Finance for specific guidance and direct support. They do great work. And you can find them at remnantfinance.com.